This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Today on the show, I have Tim Dyer. Tim is an RIA, a registered investment advisor in La Jolla, California. Tim and I have been friends for several years and knew each other when I was living in San Diego, the San Diego area. And we always have these conversations about RIAs and products and brokers. And Tim has seen the brokerage side of the world. He's seen the RIA side of the world. So this is kind of a conversation with Tim and I just sharing some of our insights about how these worlds work and how clients navigate these worlds. An interesting conversation. I hope you enjoy. Tim, you are a RIA, registered investment advisor?
That's correct.
Okay. So I want this to just be an educational conversation between you and I. So everyone's gonna be able to find out about what you do and all more about you and all that kind of stuff. But I really want this to be kind of a conversation where we can walk people through this whole process from your perspective. As you are an RIA based in La Jolla, California. La Jolla, for those people that don't know, is it's a pretty well-off area. San Diego in general is a pretty well-off area. I'm not so sure that's necessarily related to our conversation today, but just some context. So, Tim, is an RIA. Explain to people, and you're not allowed to go sales pitch on me. You're not allowed to go academic on me. Explain to people what an RIA does or is supposed to do for the average investor out there.
Well, if somebody could give me a simpler definition, I'd love to have it. But I'll just say this. If you look at it from a 30,000-foot level, you have sort of two types of financial relationships. You have what seems like a more traditional one where you have a broker at an investment firm like Merrill Lynch or something. And those guys are registered with a broker-dealer. They have a Series 7, which allows them to sell products. And an RIA is somebody that's registered with the SEC, and they just provide advice for a fee, right? So again, not sales pitchy because I've sat on both sides of the ledger, but an RIA is somebody that is getting paid for the advice that they give. I guess that's his most simplest form.
Okay, why don't you break that down into like kind of a tangible example, advice that they give. So that means you are talking with a client, a new client comes to you and they say, hey, I've got this account and my account has $500,000 or $1 million or something. I don't know what to do. Is that how the conversation often starts?
Yeah, I mean, and there are definitely different ways that different RIAs run their business. Some people run sort of a financial planning based module where, they might literally bill by the hour. So for $100 an hour or whatever it might be, to sit down with somebody, write them a plan, hand it to them and say, here you go, here's the bill. Whereas we don't necessarily, we do it from a wealth management perspective where we sit down, talk to the client about all the different issues that go into it, whether it's the actual investing part of it or longer term type planning. And the way our fee is derived is from the assets that we directly manage.
Okay, so that means you have a power of attorney over making buy and sell decisions, or they have to sign off with you before you do it?
Once they engage the firm, they sign an investment advisory agreement, which just engages us and part of our investment advisory agreement, which is
I'm confused. So we have, look, in my world, my world. So you got guys that are trend following fund managers. And basically you say, here's a certain amount of money. And now you've got power of attorney over my money, trade it via the system. So that's not what you're doing. That's not the RIA world. And the RIA world is the more dominant way that people come into the managed money arena, not the world that I'm in. So I really want to kind of paint a picture so people can be really understand from a clear standpoint the differences. So it's not a matter of somebody saying, Tim, here's $1 million, you have power of attorney, like a trend following fund. It's different. Help me to understand that difference.
Yeah, and I know exactly what you're saying. There are RIAs that are pure money management shops. A lot of the guys that have been on your program before are actually, they're like RIAs, but they're CTAs. You know, in the RIA space, you might actually be running a trend following strategy exclusively, or you might be consulting with clients and either internally or externally outsourcing, you know, the money management part of it. Does that make sense?
I don't know. I'm asking the audience right now. I'm going to keep pushing on this because I think it's useful. And it's even useful to hear me and you just banter back and forth to try and find a simple way to describe this. Mm-hmm. So, okay, let's go back to the broker side of the equation for a second. I mean, for example, my father, I think, still is in that kind of traditional world where there's a broker perhaps at Merrill Lynch and that's who he speaks to. Or there's a small brokerage firm in Virginia and that's who he speaks to. What's the difference between that for the audience out there? What's the difference between that and an RIA?
Well, from the client's perspective, it's going to look almost identical. Okay. Now, I'm sure there's people out there that will throw their arms up on either side of the table and say no. But at the end of the day, you've got advisors or brokers or whatever. They're trying to help their particular clients. On one side of the equation, I think the brokers would argue it's better on their side because they've got all these supposedly vast resources of these major firms with global reach and all that type of jargon.
We're talking the Schwab, the E-Trade, all that kind of stuff.
Yeah, well, more like the
Merrill Lynch.
Yeah, the wirehouses, as they call them. That's really good. They certainly have some of those things. The bad side is that if you actually think about a broker, he's straddling a line between, you know, on his left, he's got a sales manager that's saying, look, we've got to do business this month. Here's a fund that we've got to get out to our, you know, clients that it's suitable for. And on the right side, you know.
Well, let's talk about that for a second. What do you mean a sales manager? So you're really telling the audience that on the broker side of the equation that perhaps there's some energy that goes towards getting the clients of some brokerage firms involved in investments that really aren't necessarily good for the client but are better for the brokerage firm?
That conflict definitely exists. It's a major sort of pink elephant in the room.
Well, I mean, I know it exists too. I just enjoy listening to. It's like talking into deep throat, you know?
Yeah.
By the end of this podcast, you're going to be like, Covel, you cannot put this podcast live.
No, I mean, I was in that world for 10 years and, you know, my background starts there. But again, as you sort of evolve, and if we just step out of this industry for a second and think about, you look at accounting, right? A lot of guys come out of business school or the Ivy Leagues and they head right to KPMG or Arthur Andersen or Price Waterhouse, and you know they get a lot of exposure to whatever the accounting or business or M&A world. Then after they kind of figure it out, a lot of them, or the real good ones, usually just spin off and set up their own gig. Say, look, we can do this on our own without all this overhead and nobody telling us what we have to do. You find the end result that's right for the client, and there's quite a bit of value in that, I think.
I think that right there probably gives people a nice, easy wrap their arms around the idea of the difference between hiring Merrill Lynch and hiring an independent RIA. Would that be fair?
Yeah, you know, there's another example I'll give you. And again, this isn't, you know, bashing, you know, either side or whatever, but
I can always do that.
Yeah, I would say this. Okay, so a broker operates under what's called a suitability standard. You know, they have to provide investments that are suitable.
What's the definition of that?
Well, I'll get into that. I'll give you into that with an example. But on the other side, a registered investment advisor, they're bound as a fiduciary. Okay, so there's actually a legal obligation of putting the client's interest first. Now, I'll say on a side note, look, most of the brokers out there, they're not out there to just harm their clients. But there is a difference between suitability and, a fiduciary responsibility, which is the best solution for the client. And I'll give you an example. Let's say a retired man comes to you as a broker and he says, look, I've got $1 million in my portfolio. I want to generate $50,000 in income off it. Looks like I need about 5% a year to do that, right? Well, the broker could say, okay, I need investments, that are pretty conservative and can generate 5%. So he might recommend a mutual fund, and maybe he recommends a mutual fund by PIMCO. Now, I'm here in California. Right up the road is PIMCO. Everybody knows about Bill Gross. He's a phenomenal manager. He runs the biggest mutual fund on the planet. And, that fund might have been averaging 5% a year with dividends and interest. But that client now, to get into that fund, might have to pay a significant, sales charge, or they call it a load. That's the jargon on Wall Street, to get into that fund. And let's say it's 4.5% or 5%. All right. So you take $1 million and you put it in this fund, and it generates that 5%. If you were to stand in front of a judge, you'd probably fall under that rationale that what you did was suitable for that client. And that generated a $45,000 commission, right? Now let's just say, and I know
how can you generate 5% for the client? Is it 5% for the client holding your nose and pretending that you just didn't make 45,000 off because when you take 45,000 from $1 million and then you have to get 5%, it's not really 5% off $1 million anymore. It's 5% off the 45,000 less, or do people just forget about that?
Yeah, no, that's certainly true. I mean, it lowers your initial investment expense, and the mutual fund companies are, they're paying that, so they're upfronting some of the internal expenses that they look to collect, over time. But I got to give you the second half of that equation. So, when I started in the business in 1998 at a business school, money market was 5%. And you can put your money in cash and get that. So let's just say the equivalent was a CD. So let's just say that, that $1 million client needs that 5%. The broker is faced with this dilemma. I give them $1 million in this mutual fund, which has plenty of accolades and, shiny stars that go with it. And they've got a CD that essentially has, zero risk and pays that 5%. And the commission, instead of being 45,000, it'd probably be about $45. You can see where there's a massive conflict of interest there. You're telling somebody 45,000 or $45. Both of those fall under a suitability criteria for a client from the brokerage perspective.
Who invented this suit? This is like all, and I'm asking these rhetorically, but these are federal regs that $45 or 45,000, they both would be suitable. They would both be suitable in an equal sort of way.
Yeah, I mean, if you pick up a newspaper right now, I mean, this is it. This is a civil war. I mean, the Financial Planning Association, which is saying, look, we're a fiduciary and this and that. And then you've got the Wall Street side that's saying, look, we don't want to be held to this, fiduciary standard. We don't want that. That's not a good thing for them.
This is, Tim, let me jump in here real quick. I mean, at some stage of the game, and you're on the side that's coming, you're on the fiduciary side, but it's, to hear you explain it, just kind of in very rational terms, it's kind of twisted. And I think for people out there that think that there is a regulatory authority that's looking out for your best interest, even when they use terms like suitable, I think people need to kind of dig in deeper. Hence our conversation. It's giving people an inside look at how this is all laid out. Let me let you go.
Yeah. Yeah, I mean, look, suitable is a cheeseburger, right? It'll fill your stomach and, you won't be hungry for lunch. But, a salad, is probably better if you've got a certain objective. Yeah, just throwing a horrible analogy out there, but
that's a pretty good one, actually.
It's definitely a big issue. And I'll tell you, coming from that world, when I was in that world, I didn't know that. I didn't see it that way, because when you were offering advice to clients, you're offering advice and you're doing your darndest to help them, but it's very murky how that actual business relationship is set up with the client, because the firm actually views the client as a client of, the major firm. Whereas, I looked at it like, oh, these are my clients. These are the people I have the relationships with. They're doing business with me. I happen to work at this firm. But that really isn't the case there. And now that I'm on, the independent side, it's much clearer.
Well, let me interject, because we've have a little banter here, and obviously we know each other. Yeah. But just to be clear, as we talk about these things, reveal things, I want the audience to understand. We'll get to this later, but I want the audience to understand that you and I have discussed, for example, your desire to get your clients to understand, for example, black swan protection. Something. So, there is we're having this conversation because I know you, and I know we've had these in-depth conversations about how your clients can find better situations, better opportunities, better things that meet their needs. And since you do know about my world some, about Nassim Taleb's world, that it's this black swan idea. Anyways, let me get you back to the fiduciary side, because you were making that comparison. I might have interrupted, or maybe you were done.
Yeah, I mean, it's easy to get sort of mired down in the jargon, but attorneys operate under a fiduciary standard. I mean, doctors, they have their own, I think it's called not the Hippocratic Oath or whatever, but, do no harm. If somebody's bleeding on the side of the road, before you worry about getting sued, you're protected by helping somebody. In the RIA space, 90%, well, I don't even know, that number's changing, but most people that operate as RIAs are solely fiduciaries for their clients. Now, there's this new world out there where you can link up with a broker-dealer, like an LPL Financial or Cambridge or something like that, and you can be an RIA, and then you can still offer, quote-unquote, commission-type business through a broker-dealer like LPL. And that grays the line even more. So you say you're a fiduciary, but yet you've got this other side. So most of the guys that do that are doing insurance or annuities or something like that. Not all. It's not a blanket statement. It's not all. I'm just saying. It
is terribly complicated for the average investor out there. The average investor that has 50 grand, or frankly, the average investor that has $1 million. It's a terribly complicated landscape. And for example, even in my world, where I would love nothing more than to talk only about the strategy, I invariably end up having to either not necessarily defend, but to talk about the quote industry of trend following. And so people want to have these conversations about regulatory issues with me and assets under management and hot money and all this and moving around. And I'm like, hold on, let's talk about the strategy. Let's talk about the benefit for the end user, and all the other stuff, as we're talking in our conversation right now, frankly becomes sales talk.
Yeah, I mean, you got to think of it too. So you look at things kind of from a bottom-up perspective, and I don't necessarily mean like in the investment management terms. You might be looking at a particular implementable trend-following strategy and maybe dissecting that and how that works. But from my eyes, it's a top-down type approach to get to that. So if you sit with a client and they have these types of needs, these types of belief systems, I might have to introduce some things that they've never seen before that actually might make them feel uncomfortable a little bit, because it's not what they're hearing day to day in the paper or on CNBC. And then from there, then introducing some of those strategies, that can help protect them in some of these different environments.
Yeah, I mean, absolutely. It's definitely a difference. I am really, what I do in my world is more kind of, you find Michael Covel and what he's doing, and you have to decide whether or not it fits you, where in your world you are helping to introduce, and perhaps the term is maybe even handhold people to get them to a new understanding.
Oh, for sure. For sure. So we were talking about this fiduciary suitability, right? If we put that to the side and you think about from the client, your listeners, clients out there that are investing their money, they can go to whoever they want. And they should talk to a few types of people. But the point is, if they're getting a similar line that everybody else is spewing, then they're going to get the same results that everybody else gets. And we've seen historically that line might not be the best one to toe. It's sort of that herd or sheeple type mentality, right? They'll just sort of go up the hill, and then, fall off.
Black swan hits.
Yeah, you get wiped down and, back up and up. And so, we see that in everything. We see that in everything, a lot of different parts of our lives. I mean, using sports analogies, even when you watch an NFL Sunday, a team that you think might just win by 40 points, they can lose. Things can happen in this world that we can't even imagine.
Let me throw something out there about the benchmark issue. I had someone hit me the other day with this. They said, well, it kind of looks like a trend following performance has not been as good for the last couple of years. And what do you have to say about that? And they were like, well, and it was kind of the trend following is dead story that comes out.
Yeah.
And and he went on to further say, and it hasn't kept up with the broader market averages. And my response was, well, hold on. Trend following is correlated to broader market averages at about zero. It should not benchmark the S&P and the Dow. And if it does, then why the hell would you be buying trend following? The whole idea is to give you something that's not correlated, absolute return stream, different than the broader market averages, that also has kind of the black swan mentality built into it. Mm-hmm. Anyways, slight tangent, just kind of getting the idea of benchmarks there.
Yeah, no, you're right. And I'll tell you, that argument is the equivalent of Led Zeppelin going into a House of Blues and everybody screaming, play Stairway to Heaven. It's the same conversation that you have to have over and over and over again with people, because that's how the average person is wired, right? This is doing well. This is not doing well. That means that what's not doing well must not be viable, and therefore it should be discarded. I give the music analogy because I think about these guys that have these one-hit wonders that, it's the thing that pays the bills, and they just roll their eyes every time they have to sing the song again because it's like the same thing over and over. But, when you hear about benchmarking, look, it's music to my ears. The more people say trend following is dead, it probably means the next swan is closer than people think.
Yeah. Well, but then again, we might not have to worry about it now because the world's greatest investor has declared that the United States Federal Reserve is history's greatest hedge fund. And even if you did not know you were in the middle of a hedge fund investment, now you are.
Yes, you are. And the punch bowl just got spiked. The bars got open. They didn't close at 2. They're now open till 4. Feels pretty good for some, but it ends even worse for most.
Well, and I know you're not necessarily trying to predict there. I think we can just look at the last 15 years and say that when interest rates get goosed down, animal spirits usually happen in the equity markets, and either the Fed pops it or a market anomaly pops it. The key is you have to make a choice with yourself. Do you want to just ride that massive Fed bucking bronco, so to speak, or do you want to try to do something different? That's ultimately what our conversation is about today. Do you just want to trust the system? Because if you just want to trust the system, there's sure as heck no reason to listen to Mike or Tim. Just go trust the system and just be done with it. Go do whatever you want to do in your life, but if you want to do something different, I think that's some of the perspective we're giving today can be helpful.
Yeah. And, again, the following the system now, or maybe you're in a Bogle type, low cost index fund, type of strategy, it's going to work every day, every month, every year until it doesn't. I know that seems simplified, but getting back to how all this stuff works, when people understand the mathematics behind compounding gains and losses, you start to understand why that's important. You can't just take the good and bad and say it evens out and you come ahead. Because, you've heard it time and time again. 10% takes you 11 to get back even, or 10% decline takes 11. Okay, that's not that big a deal. But 50 takes you 100. And that's what we saw, 2008, 50%. We're all talking about how great the markets are and how, high the indexes are at all-time high, but that just filled in the dirt, that giant meteor crater that was put in your backyard.
So I just want to be clear with the audience as we pick up with plan B here, plan start number 2. It's not because I have any lack of respect for Tim Dyer that all of a sudden I need to leave my quote office to go make a quick pit stop. And but since I know you, and since you're doing a new podcast these days yourself, you appreciate that people get bored sometimes with a bunch of idiots talking about finance. Anyways, the reason I needed to leave is because they were delivering my new visa at the wrong time. And if I didn't get an updated visa, basically they put me into the gulag starting October 1st. So where I'm living, I guess they register you with the local authorities and all this stuff. I'm sure this is already causing people to think that since I'm in a communist country, there's a lack of freedoms that I have to register with the authorities. There's massive numbers of visas. But actually, it's kind of cool. Anyways, back to talking about RIAs. Let me shift gears on you. Let me shift gears to benefits. And I've seen this discussion here recently where clearly there are the doomers and the end timers, and many of them populate zero hedge, and zero hedge is notorious for skewering the Fed. And frankly, I think much of what they say is correct. But on the flip side, there's a lot of people out there these days that'll say, well, hey, hold on. The Fed saved everything. Stocks are at all-time highs. What are you complaining about? And I find it extremely disingenuous for people to focus only on the benefits. And sometimes people will come to me and they say, hey, Covel, you talk about all the benefits of trend following and you don't talk about the downsides. I'm like, well, hold on. I've put about a cross-section of about every public fund manager for the last 30 years in my books. They show all the performance. You can see all the ups and downs. But I find the idea that people just want to say, hey, stocks are at all-time highs without asking what the risks are. And we've seen this happen twice in the last 15 years. I mean, how was everyone feeling at about January of 2000? I mean, it was like, you know what happened in 1999. NASDAQ was up 100%. So are you seeing this in your practice, in your discussions? Have people almost after the last 5 years just given in and said, what risks?
There's really two forces at work here. There's a major force of, a potential decline, or, okay, we're going to go back to 2008, for example. But let me tell you, there's an equal force that they're going to miss the upside. Like Harry Dent was on your show not too long ago, and he's back at Dow 30,000 or whatever it is. Well, look, there's a big fear of missing out too. And problem is a lot of the general investment strategies that are out there, they just sort of ping-ponging around, between this fear of missing out and fear of losing money. Very few of these programs, whether they're investment strategies or philosophies, have any kind of process that allows you to sort of be in a good part of the up and be out of a good part of the down. It's not the easiest thing to explain. It's not something that you can just rubber stamp, put it on a silver platter and just offer it to, anybody that lives and breathes and has $100 in a brokerage account. I mean, and that's part of the hurdle. But that's also what makes something like this effective. Because by nature, if everybody was doing something, then you couldn't create asymmetric returns where your gains are larger than your losses, or the magnitude of your gains are larger than the magnitude of your losses.
At the end of the day, all you can do is really follow along. I mean, you can't predict any of this stuff. I think the thing that does bother me is that when you have so much government intervention, and I didn't follow this as closely as some people, but the whole discussion was there was going to be a, quote, taper in the fall. And when there's no taper, you just start to wonder, now this is not trading advice. I'm not saying to make any decisions with your money on this, but what does what do members of the Fed know that we don't know that has required them to keep this massive stimulus going on for 5 years? What do they know? Because clearly it's not normal markets when the government is in all markets essentially at the levels they are. So
that's the red bull. That's the red pill, blue pill, right? Yeah. I mean, it's like, you know too much. You take the pill and just, forget everything and go back to the stoic state. Or do you accept that there are things that, most people may not be aware of? And, you don't have to exploit or capitalize. You just have to be aware of them and make conscious decisions for what's appropriate for you. Look, there are people out there building bunkers and, that stuff. I mean, that's a little far to one side of the curve for me. But I also accept the fact that those risks are out there. And I just choose in my life not to take it to that extreme. But on the same token, there are other, whether it's financial or, other risks that are out there that, I prepare for. And if it means I have to give up a little upside in the stock market in the short term, so be it. To protect from that tail risk, as you call it, which is the, 6 standard deviation move, according to Nassim.
Yeah, and they happen. They happen.
I'll tell you, I was at a industry conference up in Laguna Niguel, actually not far from where you got that interview with Mike Aponte. And one of the head quantitative analysts from Fidelity Investments was out there. Sharp guy, real good speaker too. But he gave this presentation on interconnectivity that really would send a chill down anybody's spine. It goes back to what does the Fed know that not everybody knows? You think about this. So we saw how at risk the banking system is. And we saw how, look, we're going to need a massive injection here to save this thing. But when you think about it and you put major mega corporations, like Target and Walmart, who use those banking systems and other industries, when you connect them in one of those molecular looking graphs, you realize that everything is connected. Again, it sounds, Thomas Friedman, the world is flat-ish, but it's true. And the more and more and more everything gets connected, the more and more everything is going to move, and more correlations will start to tighten up. And then that means when things start to cascade, then you get that just massive ripple effect, which can create things like the flash crash. All the algorithmic trading is starting to get on the same side. Then it moves. They're all trained, to stop out. It just creates this massive, in that case, a decline that you just you can't foresee. And so you have to always sort of have some preparation for events like that. I just think that's highly possible out there.
Tim, what is the best way for people, if they want to talk about the end times, to reach you?
Hey, I'm an optimistic guy. I'm a lot more optimistic than I think we've talked about, here. But, I can be reached through our company website, which is sage-cap.com. My personal email is T-Dyer at sage-cap.com. Love to chat. Anybody who wants to talk about any of this stuff.
Absolutely. Well, fun chatting. We will talk again soon.
My pleasure. Thanks for having me on, Mike.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.